The dollar ticking lower today. The greenback seen sharp declines so far this year, with dollar weakness indicating investors are seeking safety in global markets outside of the U.S. Here with more on the future of the dollar as a haven trade, Jane Foley, the head of FX strategy over at Rabobank. Jane, amazing to speak with you. Thank you for making time with us this morning on a very important day in terms of the currency trades here. The weakness of the dollar right now, how do you read that weakness? What is it signaling to you?
Well, to be honest, at the end of last week, it was a little bit unusual where you had the safe havens, the yen and the Swiss franc certainly been sought after. The dollar was left out in the cold. Now, clearly, there was something to do here with the anticipation, of course, or that the market could be reevaluating the whole view of investment in the US. But the US dollar, like it or not, is the global reserve currency. It is a huge invoicing currency. And if this crisis were to worsen, there no doubt would be, to some degree, a shortage of dollars somewhere as people need their dollars to pay their invoices, etc. So it was unusual to see the dollar faltering to the extent that it did at the end of last week. Now, this morning, things looked a little bit more usual. For instance, overnight, the Australian dollar falling heavily, the New Zealand dollar down heavily, commodity currencies here, including the Canada, including the Norwegian krona, all falling against the US dollar. So the dollar, if you like, becoming more of a safe haven, certainly against those commodity currencies, which is perhaps what you might normally expect in a sort of crisis. Now, at the top of the pile this morning was still, of course, the Swiss franc and the yen. I've got to also mention that there was pretty low liquidity in some of these countries, meaning that there was, very, very sort of loose ranges here as well. But I think the remarkable currency here has been the resilience of the euro. Yes, it is off its highest levels against the US dollar, but it has been extremely resilient. I think we could really do with a little bit more of a pullback in euro dollar to normalize the situation here, because like I say, like it or not, the dollar is a currency that people need when things become stressed.
Yeah, what is the currency hedge to sort of win them all right now, Jane? Is it the euro in your view?
Well, that, I think, has been the view over the last few days. Sure. The euro, I mean, certainly it has underperformed, the Swissy and the yen, as you might expect, but it's done remarkably well. But that makes me feel pretty uneasy now. Yes, the fundamentals of the Eurozone, a month ago certainly improved, and that was with the debt brake being adjusted in Germany. The outlook for growth, for instance, in the region really taking a step higher. But there is a question of timing here, because big forecasters in Germany are putting up their 2026 forecast for German growth and onwards, not their 2025 forecasts. A lot of the projects that will have to be done by Germany in terms of defence and infrastructure are not necessarily shovel ready. So there is a timing issue here. I think there's potentially room for disappointment, therefore, in some of those bullish calls. So whilst we haven't adjusted our medium-term target of 112 for euro dollar, I think there is perhaps a little bit of room for the dollar to come back against the euro over the next month or so. And that would be, I think, a more normal condition, because we can't get away from the dollar's purpose as reserve currency.
Hi, Jane. It's Chris here in the studio. I was intrigued by what you were saying about the dollar, because, of course, the dollar into the Trump election and the expectation of tariffs round one was strong, and that was the whole discussion, wasn't it? That tariffs absorb the dollar absorbs part of the tariff move. What do you make of the fact, though, that tariffs announced higher than expected Wednesday last week and the dollar goes down? How do you feed that into your thinking?
Well, I suppose this is exactly what I'm saying. To me, it's a little bit unusual. I mean, certainly the market has been anticipating since January that the Fed will look more on the growth side of its mandate rather than the inflation side of its mandate. And that is, of course, why the dollar has been falling, since around about the time of the inauguration, and one of the prime reasons why it fell so much at the end of last week. The market, of course, now priced for several interest rate cuts from the Fed. But as you just mentioned, inflation is also a consequence of tariffs. And it is quite possible that the Fed won't be able to cut interest rates as much as the market is anticipated, but then normal other central banks too. The market's been pricing in a lot of interest rate cuts from the RBA, for instance, or from the ECB and a host of other central banks. Be interesting to see what the RBNZ does tomorrow, whether it sticks to its guns for its signal 25 basis points move, or if it does more indeed, because that could get the market more excited that other central banks could do the same thing and cut. But I think it is unusual that the dollar has fallen so much and has sort of ignored its safe haven status, and that's why I think euro dollar can fall back in the next few weeks.
If we start to see this current moment withstanding, where we are seeing the dollar moving up a bit, but if we continue to see this dollar weakness narrative being a little bit sticky, Jane, how do you think about how that affects kind of the impact of these tariffs, and how does that play into the economic risks of the tariffs as well? Does a weaker dollar make the impact of tariffs more potent?
Well, a weaker dollar could certainly increase the inflationary aspect for US consumers. I mean, that's why, generally speaking, or one of the reasons why normally you'd expect the currency to go up, because tariffs mean a consumption tax, if you like, for US consumers, that the Fed would become more hawkish, the dollar would go up, and therefore some of the inflationary impact would be dispelled. The weaker dollar, if it were to continue, would indeed indicate that the inflationary impact for US consumers could indeed be worse, and therefore it doesn't necessarily sit with the idea that the Fed would be cutting interest rates anything like 5 times as much. So there's a lot really to wash out here. We had the indication from Powell on Friday that he's going to wait and see. He's in no rush to come to the market's aid and cut interest rates quickly. And I do think that if that's the case, that the market might again start to price out some of those cuts that it's been pricing in over the last few hours, really, or the last couple of days.
Interesting, Jane. I suppose ultimately the question comes down to how much do you think tariffs are inflationary and how much do you think they're a tax on the consumer and therefore a hit to growth? Because that really will drive the Fed's narrative. How much are they prepared to look beyond the sort of short-term hit on inflation expectations? And if I'm right, I think 1-year inflation expectations are up a lot and 10-year are actually going down. So the market's already grappling with that. Where would you sit in that camp?
Well, I suppose nobody really knows. I mean, you could take a very straightforward textbook approach and say, yes, these are going to be a one-off, which, of course, is why the Fed's Powell reintroduced the word transitory a week or two ago when thinking about the impact from tariffs. If that's the case, then the Fed will be able to look through them. But other economists have cited the fact, well, they're not really going to be transitory. There could be sort of knock-on effects, or these tariffs could come through at different points of time. And actually, the net effect that we get is something that lingers for a little bit longer, particularly if higher inflation is then built into wage negotiations, etc. So it's very, very difficult to know that right now. And again, another reason I think for the Fed, to sit back. But by using the word transitory a couple of weeks ago, well, the Fed gave the market a free pass to think, the Fed will just be concentrating on the growth aspect of its dual mandate and not the inflation aspect. So if you like, that's what that word did to market expectations. And I think we need to see what other Fed officials say, or, the data, but it's going to take a while before we get post-tariff data to see whether or not, the Fed are really worried about the impact of this inflation or not.
All right, Jane, we got to leave it there. Thank you so much. Amazing rundown from you, as always. Really appreciate it. Thank you.